This is your dose of daily market wisdom with master trader Nick Santiago. Starting from humble beginnings, Nick has been beating the markets for over 2 decades. He shares with you his take on the profitable trades that will have you moving towards financial freedom in no time at all. To see an in-depth review of his track record and much more, go to inthemoneystocks.com. Welcome. You are listening to the Daily Market Wisdom with Nick Santiago. I'm Kerry Lutz. Today is April 15th, tax day. Oops, I take it back. Tax day has been moved to July 15th, 2020. First time in my lifetime, probably first time in yours. But in any event, this is show number 13. Nick, it's a lovely morning here in Florida. The sun is out. Went for a bike ride. Getting ready for the day ahead of us. So big banks obviously have been weak, and this is probably just the start of it, perhaps. I mean, you saw JP Morgan's announcement that they're not making any more small business loans, and they've raised the criteria on their mortgages to having a 700 credit score and 20% down, no more subprime. What is going to be with these banks?
Well, they're reporting earnings this week. So yesterday it did start off with J.P. Morgan and Wells Fargo. Both stocks were hit pretty hard. I never really listened to any of the conference calls, or I really don't even care what they say. I just look at price action because that's really the final arbiter. That's the dictator of the move. So the markets did not like the action there. And today, again, we have J.P. Morgan falling a little bit more. That stock's down $4.30 at the moment. You also had Bank of America today and Goldman Sachs report earnings today. Goldman is flat on the session. Bank of America down about $1.38. That's about a 6% decline. So not really good news on the banks, or for the banks, I should say, at the moment. But they've had pretty good runs recently, and a lot of times what you get is what we call a sell the news event. So the markets go up into the earnings announcement. The earnings were already projected and expected to be bad due to what we've had to deal with in the country regarding coronavirus and all the economies shutting down. So these banks are retreating. But what I'm going to say is you want to watch these patterns over the next week or two. They could be setting up for upside moves in the bank stocks. Right now it's just too soon. Normally any time we get an earnings announcement, I like to wait a minimum of 3 days before even entering an equity. So, for instance, J.P. Morgan reported yesterday. I won't even look at that stock on the chart till maybe at the earliest on Thursday or Friday. I'll start to glance over and see what the pattern looks like. But those are stocks that are giving me some reason, to be a little bit cautious here, but the reality of it is if that chart pattern sets up the way it's looking right now, these stocks can go right back up.
Hey, and we should talk again about your hotel stocks, Hilton, Hyatt, Marriott. You think that they're setting up for a move forward, and perhaps Delta Airlines too. We're a couple more days out. Charts giving you any clarity?
Yeah, it's doing exactly what I thought, and then we talked about on the show. I said I want to see this thing go sideways, stay just below the 70 level, and I think we talked about it first was probably somewhere around April 7th. Here we are, it's April 15th, and the stock is at 68.33. It's just gone sideways for a week, and that's the pattern I love.
Okay, and if I can divine a little wisdom about the future from those charts, those stocks are going to go higher because there's going to be huge pent-up demand to travel. We've talked about it before, and they're setting up because this thing is going to end sooner rather than later. I'm talking about the coronavirus lockdown, virtually nationwide. It's going to end, and at that point, all these people who deferred their trips to Disney World and wherever, especially if school is canceled for the rest of the season, the rest of the school year, these things, it's not hard to see it taking off. So is this something you can see in the charts from your perspective?
Yeah, right now, I mean, if you just look at the charts, and this is something that I always look for, this one type of pattern, the Hilton chart, we'll use that. The market bottomed on the 23rd of March. Hilton actually bottomed on the 18th. Hilton made a higher low, pulled back. It went up into the 26th. It pulled back all the way into April 3rd, and now it's moved up into that 70 level, and it's going sideways. This is one of my favorite patterns. I'll probably be entering Hilton shortly here, just waiting for a little bit more clarity in the chart pattern. But, yeah, it's a pattern I love, and, again, that's why I brought it to everyone's attention. You keep it on your radar, but it's doing everything that we talked about on the program here.
I love it.
And the best part about it is that if I'm wrong and it fails, we know where very quickly, and that's even the best part about it. So, your risk is limited and your reward is very, very high, and that's what you want to do as a trader. You want to have very, very limited risk and very, very high reward. Sometimes that's hard to do in this kind of market because you could wake up to a 2,000-point down day or something along those lines, but generally that's what we aim to do.
Okay, so you'll send me a copy of that chart so I can post it as a graphic when I post the show. Appreciate it. And so stop losses. We've talked about them. You've alluded to them, and it seems like really a lot of traders use them, but they use them differently than the average Joe Six-Pack average investor. How do you strategically use a stop loss?
So what I like to do as far as stop losses go is that I like to find a spot on the chart where the institutions got involved. And now that's a little bit more complicated to tell you exactly where that is, but over the years you identify it, and when we see those pivots or those levels that were defended prior, we know they should be defended again. And basically what will happen is if we do say, for instance, you buy Hilton and it trades below a certain level and it takes out a certain prior pivot from the past, then I usually will stop out of the equity. So that's how I play it. I think that's worked well for me over the past 20 years. And a lot of times if it gets below that level, I honestly don't want the stock anymore. So basically it's the market's way of providing an insurance policy for us. So you should not be able to take out a prior institutional pivot level just simply because that's where the institutions were in there. What we're doing, I always tell people, I'm just a remora. I'm the little fish that swims next to the shark, eating all his leftovers. That's what I am as an independent trader.
Yeah.
These institutions are the people that move markets. So if you take out an institutional pivot level, then you're kind of you're on the wrong side of the trade, and you should move out immediately. Virtually every time I've seen it in my life, the first loss is the best loss. A lot of times people try to fight the trade. That's certainly the wrong thing to do. Now I understand it in this environment. Sometimes you might have to do that just because you get caught in what we call a downdraft, or where the market can gap down sizably against you. So you have to be a little bit cautious in this environment. You have to give things a little bit more leeway. But generally, as far as stop losses go, you're going to put the stop loss, right below an institutional pivot.
Right. And if you want to find out more about the institutional pivots and strategies for using stop losses, then you got to go over to inthemoneystocks.com. It's got all of Nick's trading records, historical and special offer there, and a lot of educational materials that are complimentary. So, Nick, and I'm just going to ask this kind of off topic from what we had planned to talk about, but the VIX, all right? It seems to me that if you can call the market and you can call the VIX, you really can clean up without a lot of risk.
Yeah, no doubt about it. If you take a look at the VIX chart, it's what we call a parabolic index. So a lot of people will call it the fear gauge, but the VIX went from basically in February, it was trading at around, somewhere, you could even make a case even in January, it was trading around 12. It went all the way as high as 85.47. So the VIX had a big spike from the start of the panic all the way up till March 18th. March 18th was the top in the VIX, and again, that was at 85.47. Since that time period, the VIX has come down, and it is currently, at this moment, trading at around 42 and change. So you can see the VIX has really, come back in. Today, the VIX is getting a pretty good pop just on the back of a little bit of fear and panic out here, but it's an options X week. So that's not, ruled out. Nothing goes down in a straight line. Today the VIX is up by about $4.45 to 42 and a quarter. But the VIX has certainly pulled back a ton. I still think the VIX is going down to 30. So, we're at 42 and change right now. I think when we get to 30, that's where the VIX will find a pretty good little bit of comfort, and it will hang out at 30 for a while.
Yeah, and I remember a couple of years ago, they'd gotten like ordinary investors to sell options on the VIX, as somehow this is a safe bet. And then all of a sudden, one day, the VIX went from 9 or 8, because it was really down low a couple of years ago, went to like 30, and these people lost their shirts, and they didn't even know what had happened. So you don't mess with the VIX unless you really have a good idea and a really, really good risk tolerance and the ability to pull out very quickly, because that thing can move and run when you're not even, literally from the time you go get your coffee to you come back to your desk.
Yeah, it's a spike index, so when it goes vertical, it goes vertical, and when it comes back down, it comes back down pretty sharply as well. So it's a spike index. You have to know what you're doing. I owned the VIX in February. We made tremendous money on it to the upside. Obviously, I didn't hold it till the 85 level, which I wish I did, but it was still nonetheless a dynamite trade. And, now I haven't done anything with it. I still think, like I said, the VIX is in retreat mode. It's not going to go down in a straight line, but we should see it go down and test the 30 level shortly.
Yeah. Hey, your philosophy as a trader, you're always leaving money on the table, but it reminds me of Bernard Baruch's quote, "I got rich letting the other guy make the last 10%.
Yeah. That's Bernard Baruch is he was quite something. He has a lot of good market quotes. If anybody ever wants to go and look at it, every night when I do my nightly report, I put a market quote from either a trader or somebody that inspired me that I've read, and I use a lot of Bernard Baruch quotes. And he also said, "No man ever went broke taking a profit."
Yes.
So he's got a lot of them.
Yeah, a lot of wisdom. Hey, so let's talk about crude, because that is setting up. It's back below $20. That could be setting up as almost as good or perhaps better trade than gold, than GDX.
Well, yes, because crude right now is being looked at. So today we had the some economic numbers. Empire number came out. It was very, very weak, the weakest in I don't even know how long. It was a terrible number. So and crude's getting hit a little bit more today. Right now we have spot crude. The May contract trading at $19.51. It's down another 58 cents. That's almost a 3% decline. But here's something that I've been watching in crude is the contango, and what that means is that crude futures prices are higher than the spot price. So
right.
If you go out to say just the June contract, which is the M contract. Crude futures are trading at around 26. If you go out a year from now and you go out to June 2021, they're trading at around 36 and change. So we have contango there, meaning the future crude prices are higher than the spot right now, and they're a lot higher than the spot. So that tells me I want to be looking at crude, and I've been telling you on the show almost every day, hey, the pattern's not there yet. The pattern's not there yet. We're just going to let it tell us when, and it's been moving lower. But now I see this. I'm just waiting for that one little signal to get into crude, and I do think it's going to be a play there, just due to what we're seeing in the contango market there, meaning the futures contracts of crude are much, much higher than where the spot is trading at right now.
Hey, and we saw that in gold. We saw it $70 spread between the actual spot price and the June contract, and it filled it, right?
That's right, it did. And we're probably looking at something similar that will occur with crude oil shortly. Now, crude's down today on various reasons. For various reasons, you have Fauci, Dr. Fauci saying, it's unlikely that we could open up in May. It's not. So there's a lot of negative sentiment out here today thinking that the United States and the rest of the world cannot get back to business as usual starting in May. So that weighs on it. But I'm just looking at these futures contracts, and I'm saying to myself, well, it's a good story. They're going to get the spot price lower, which means I'll get it lower too when I jump on board.
Yeah, you wonder how much lower it can go, and probably not much at this point, because producers at some points just stop producing, because it's one thing when the price goes down and you're losing money, but when the price goes down and you're losing money and you can't even pay your variable costs from it, the labor and the actual production costs, then you just stop. And you see this with miners all the time.
Yeah, and the other negative is that there's going to be a lot of small oil producers that go out of business. I mean, that's just a hard reality now. And then you'll have less people producing. So when that happens, the price is going to go up as well. So there's, unfortunately, this is where we are at this stage of the game. But as a trader, I have to take advantage of what I'm seeing on the charts.
Okay. So expiration is on Friday, options expiration, and volume trends are telling you something.
Yeah, for the market, this coming Friday, we have options expiration for April, and that's always a week where you want to be, this week, beginning on Monday, all the way into Friday. You want to be more neutral. I don't put on a lot of positions this week, just for the fact that, you could take a look at what we saw on Monday. The market was down. Yesterday, we had a big advance to the upside, and today, the major indexes like the S&P 500 and the NASDAQ, they're all sharply lower. This is just typical whipsaw action that you get during an options X week. There's no real conviction, as I've been saying, even in the prior shows that we've done. This is where you have to be careful, because these institutions have an agenda, right? They want to make the small retail options trader that is playing for Friday's expiration, they want their options to expire worthless. That's where they're going to make the most amount of money. So there's a lot of game playing that goes on this week, and that's why you see these up and down moves. Next week, we get back to regular trading, and that lasts for about 3 weeks till we go to the next month's options X.
Yeah, so you kind of have to filter out the action that's taking place now, because, like you say, they make a boatload of money on people who buy options and watch them expire worthless, which is 90% of the market does not make money on options, right?
That's right. It's a very, very risky game. And you could watch this very closely, too, in a lot of the popular stocks. So, for instance, I'll give you a good example. Recently, Apple has been moving higher. The stock bottomed out on the 23rd of March. It was trading as low as $212. Now, yesterday it traded as high as $288. There's no doubt in my mind that yesterday we probably had options traders playing for Friday's expiration, and they went and probably bought the $290 strike price. Well, today Apple's down $3. So you just they're not going to let these things pay off. That's just kind of what I'm trying to allude to, is that there's a lot of game playing that goes on this week. It always has gone on, and it always will, and that's just why if you're going to play the options market right now, you want to give yourself time on the clock. And I always tell traders, I don't use the weekly options, but I always tell them, give yourself on the monthly option 60 days at least if you're going to get involved in any kind of option play.
Mm-hmm. Yeah, which makes sense. You're going to pay a little more for the time premium, but you're upping your odds of actually turning a profit on it, because you got more time and everything is uncertain. The further you go out, it becomes more uncertain, of course. And so you're thinking if we see a decline in the next couple of days on light volume, that it's setting up the market for another move higher?
Yeah, I am. So if you take a look at the volume trends, and you could use this on the spiders, and if you recall back in January, I told you, I said the market will get toppy when we start to see high volume. And sure enough, we got that high volume day, and that gave me my sell signal. And obviously, I didn't know coronavirus would be the pin that pricks the bubble, but you could see that the markets proceeded lower, and that was a correct call. Now what I'm seeing is, on Monday, we traded 115 million shares in the spiders. Yesterday we traded 134 million shares. Today we're trading just 41 million shares, and right now it's around 11 o'clock. So we see the volume has dropped off compared to the 200 plus 300 million shares that we were trading in mid-March. And if we pull back on light volume, that usually will give you a setup that the markets want to go higher. So again, I'd love to see a pullback here because I'm not participating on any new positions up here at these levels. But once we get that pullback and we see the pattern set up, I will be jumping on board to the long side in some equities.
Gotcha. And it makes complete logical sense here. Hey, just to touch on gold and silver. Gold is down today, and silver down. I haven't checked the GDX yet, but I assume it's also fallen a little bit.
That's down as well. Yeah, it's down 2%.
Yeah, so it's down to 30, roughly a little more than 30. So interesting because you kind of called for a pullback here. Whether this will be it or it goes a few more days, I guess we'll have yet to see. But pullback, when you notice these pullbacks in a rising market like gold, how much is their duration generally, and what kind of losses do you see? What kind of pullback?
Well, anytime a chart, we'll use gold just because that's something everybody can look at. If you look at a chart and you go vertical, you know you're going to pull back at some point. Yesterday, if you look at gold futures, had a tremendous day, made a new high, and then came back in by the end of the day. And anytime that happens, it tells you that the buyers up there are limited now. You don't have as many people willing to put money into it up there at that level. So when you just see that pattern, the psychology of it tells you that we need to pull back. And then you never know how much of a pullback you're going to get, but you just know that it has to work off that so-called overbought condition. And that's what happens when you go vertical. You get this overbought condition. So what you do is you wait for it and you watch the moving averages. I like to watch the 20 and the 50-day moving average. When they start to creep up towards price, you know you've kind of worked off that condition, and ultimately price can start to resume another move up. But there are certain patterns that form. I never know what pattern it's going to give me. I just wait on it, and when I see it form, then I take action.
All right. Excellent. Yeah, and that makes a lot of sense. So those moving averages, they call them like the 200-day moving average is called the gold cross, right?
Well, the golden cross would be when the 50-day crosses over the 200-day.
Yeah.
So they would call that a golden cross. Then the death cross would be when the 50-day crosses below the 200-day. So you got a lot of these crosses and fancy names, but honestly, there's a lot more that goes on between, besides that really makes the trade. But, they do have some fancy titles out there for some of these things.
Yeah, the death cross. Yeah, we've seen that. We've seen that happen, but it doesn't always mean anything. That's the thing.
No, there's very often you can actually get below one moving average can decline below another and then loop right back up. I've seen it hundreds, if not thousands of times.
Yeah, so it's kind of for the public's consumption then. Really?
It is.
Yeah, we'll look at the moving average in gold. The 20-day is up 14%, 14 plus. The 50 is up 10. The 200-day is up 20, almost 22%. So year to date, we're up 14% on gold. I'm talking the June gold contract there. So, so interesting. They're all kind of pointing in the same direction there.
Yeah, and in all fairness, gold should go higher. Really, when you think about it, all the money that has been printed, all the stimulus programs that are taking place right now, I mean, I ultimately remain very, very bullish on gold. But like I said yesterday, it's getting to a parabolic level where it does need to come back in. Nothing goes up in a straight line, and it's not healthy to go up in a straight line. If you do that, then ultimately you will come crashing back down. And hence, you could take a look at Galactic Space, ticker symbol SPCE. You could take a look at Tesla when it went to 960. All of these things that go parabolic will come back down to earth. And, gold is just another equity. So, nothing can defy what the human psychology is that's moving it.
Yeah, I think that's a great point. We'll leave it on that. So make sure you go check out inthemoneystocks.com. Check out the special offer there and the complimentary training materials, as well as Nick's trading history. And questions or comments for Nick, just write me, kl@kerrylutz.com, kl@kerrylutz.com. All right, Nick, we'll talk to you tomorrow.
Thank you.
This is your dose of daily market wisdom with master trader Nick Santiago. Starting from humble beginnings, Nick has been beating the markets for over 2 decades. He shares with you his take on the profitable trades that will have you moving towards financial freedom in no time at all. To see an in-depth review of his track record and much more, go to inthemoneystocks.com.